So my name is Cameron Mountain.
I'm Alex Markgraf.
I'm Corey Center.
Eric Page.
And I'm Brian Wynn.
We are at Oregon State University, and today we are presenting Lithia Motors. So Lithia is headquartered in Medford, Oregon, and was founded in 1946, but was not incorporated until 1996. Lithia currently offers 31 brands of new vehicles, as well as all types of used vehicles, in 135 stores, and they have recently added 34 more stores through the DCH acquisition. Lithia operates domestically in 14 states, mainly on the West Coast, but with the DCH acquisition, they did get exposure to the East Coast in some major metropolitan areas.
So Lithia operates in 4 different business segments. The first being new vehicle sales. New vehicle sales is comprised of 55% import vehicles, 33% domestic, and 12% luxury brands. Compared to the national average, they are higher in their import and luxury brands and lower in their domestic brands. New vehicle sales have gross margin of around 6%, and their DCH acquisition, as mentioned before, is giving them more exposure to this segment. The next segment is used vehicle sales. Used vehicle sales margins are about twice that of new vehicle sales, and there's a growing focus from management on used vehicle sales, given that the used vehicle market is about 3 times as large as the new vehicle market, and it makes up around 30% of revenue. The next 2 segments are financing and insurance, and service body and parts. These 2 units of business help to increase customer retention and bring people back in the door as they're driving longer and financing their products. Their F&I per unit was, as of 2014, $133 lower than their peer average. As of their latest earnings report, this was up $73, which is something that they're continuing to focus on. Their financing and insurance arm contributes around 3.5% to revenue, and service body and parts contributes around 10%.
So moving on to industry conditions and risks, these factors kind of stood out as the most prominent. So first we have the aging U.S. auto fleet. So about half that outstanding fleet is early 2000s vintage, and so if you trade in about 5% of those, we'd be looking at 13 million units in sales north of there. So we think for that reason, despite the fact that auto sales were at a record high last year, we're going to continue to see that be at elevated levels. And the next touch on the price of crude, so that remains pretty subdued, and we think it's going to remain subdued for at least the near term. If more people are driving, that's going to translate into more demand for the high margin service body and parts segments of the auto dealers. And then also in addition to that, it's going to benefit sales of SUVs and pickups. And then finally, touching on consolidation. So over the last decade, the amount of dealers has come down about 18%. And so the surviving dealers, especially larger companies, have seen not only greater sales volume, but also they've been able to utilize economies of scale to price those smaller competitors out of the market.
So from a competitive positioning standpoint, there are 3 cornerstones of success for Lithia. The first one is operational growth, and we see that by 1/3 of the markets that Lithia is currently in have yet to return to pre-recession levels, which leaves room for improvement in SG&A costs. The second is financial discipline, and we see this by Lithia having $304 million for growth through a combination of cash equivalences, unfinanced real estate, as well as availability of line of credit. And looking at short-term debt in 2016 to 2021, they only have $147 million due. In 2021 and beyond, $244 million. And Lithia looks to grow through acquisitions, and there are 17,800 dealerships in the United States. The top 10 largest dealers only own 7% of this market, so there's a lot of opportunities out there. And for 2015 peer comparison, we see that Lithia Motors is the smallest in terms of billions of revenue, but they also had the highest same-store sales growth percentage of 11.7.
Moving on to some of the financials for Lithia, I'll go over some of the income statement highlights. So this last year, they posted a record Q3, which was the most recent earnings at the time of our report. They've been able to grow their earnings per share consistently in the past and reach their targeted milestones. So due to their recent success, management has placed an $8 target on earnings per share on top of their previous $6 and $7 targets. We believe that they'll reach this in the next 3 to 4 years going forward. And then another key line item for Lithia is SG&A, which, as you can see, there's been some recent volatility due to the acquisitions they've been involved in. And management would like to see this margin of gross profit to be at around mid to upper 60% range. However, we believe they might have some difficulty reaching this target, so we forecast it at 70% going forward. And as you see at the bottom graph, that represents their organic revenue growth in the past and going forward related to their milestones.
And then looking at financial health, we look at the DuPont analysis for 2014, and most line items did go down, except the tax burden, interest burden, and the leverage ratio, which all increased due to the DCH acquisition that took place that year. And since the leverage ratio has been increasing over time, the return on equity has also gone up as investors will require a higher rate of return. Looking at the bottom graph, we see here in 2014, net borrowings was at 184 million, which has now turned into net repayments of 61 million. And the use of cash to pay down credit has been in pace with CapEx, but future acquisitions may cause a divergence in this as 25% of CapEx is used for post-acquisition improvements.
So for the valuation of Lithia, we started with the discounted cash flow model, which we projected out for 5 years. We used most of our growth rates and relied on management and historical data for those growth rates. For 2015 and 16, we kept revenue in line with management guidance and then used a 6% growth rate for the remaining years. For cost of goods sold, we separated out by individual segment and relied on guidance for those margins. And then SG&A, as I mentioned earlier, we kept at a flat 70% for our time horizon. Moving to the working capital model, for the balance sheet line items, we tapered off to remain at a sustainable level for the 5 years we forecasted. And then moving to capital expenditure, we used guidance for 2 years to arrive at free cash flow.
So moving to some of the underlying assumptions in our DCF model, we calculated our cost of equity with using CAPM. We estimated a risk-free rate of 2.6% using the yield to maturity on the 30-year U.S. Treasury bond. The beta that we used was 2.21, which was calculated with the 5-year monthly regression. We calculated 6 betas in total. It shows the one that yielded the highest R squared. So that's how we arrived at our cost of equity of 15.9%. Our cost of debt was estimated using the NYU Stern synthetic cost of debt. So essentially what we did was calculate the interest coverage ratio for Lithia and then assigned a spread over the risk-free rate to arrive at their cost of debt of 4.12%. This spread was equivalent to an A-rated company. And while it may seem low for such a small company, we feel that is appropriate given that the majority of the debt that Lithia holds is secured by physical assets such as real estate and vehicles. Additionally, their financing and insurance arm, which could provide some risk given that people are needing to make payments on their financing. All those contracts are sold to a third party, so they're not really assuming any risk after the sale. So we did feel that this is appropriate. Our DCF gave us an intrinsic value of $80.73, which was undervalued with the current price as of yesterday at $92.72.
So just real briefly on the relative model. So we assigned the most weighting to AutoNation and Penske Automotive Group. Those are the biggest players in that space, but we did give a little bit more weighting to AutoNation since it has a relatively similar new vehicle revenue mix compared to Lithia. And then the third most weighting we gave to was Asbury Automotive Group. So like Lithia, they operate purely domestically. In addition to that, just from a revenue size perspective, they're very similar there. So that model gave us a 96.27 value.
Looking at their historical model, we took the high and low PEs and averaged them together over a 2-year, 4-year, and 6-year period. As you can see, that yielded a valuation of $89.68, which is just a little bit below yesterday's close price. Overall, we are recommending a market perform on Lithia, given how we started with the report. It looked like our dollar valuation was going to be pretty good, but given the recent performance of the stock, we are recommending a hold. Overall, our valuation was 88.99. Any questions?
So one of the breakouts you had looking at competitors, I don't remember the exact number, but I think you said that same-store sales for Lithia were 11% plus, and for the competitors, they were all kind of in the mid-single digit range. What do you think explains the difference between Lithia's same-store sales and those of their competitor?
So what we looked at in their 10Ks, they talked about kind of the entrepreneurial spirit of these stores, and then using their main headquarters is where they do like all the operational standpoints, so that these their kind of outlets, or they just have to mainly focus on selling the vehicles. They don't have to do any of the operational dealings, and also hiring the best managers to run those stores. So.
How smooth is the transition when they acquire these dealers to affect the operational efficiency that you're trying to factor into these modeling? How smoothly does that go?
Go ahead.
So after reading their recent earnings report just a couple weeks ago, it said that their DCH deal was done as of this past October, and all the cost synergies are completely, they're all synergized right now. So we felt that was done really fast compared to maybe other acquisitions dealt with. So it seems like they have a good idea of how to really make these efficient in a short time period, because based off of how large the DCH acquisition was and how fast they're able to get those cost synergies in place, they'll be able to realize these gains pretty quickly.
So between your written report and your presentation, you changed your rating and I believe maybe your intrinsic value. I'm not sure about the intrinsic value, but originally you recommended it as outperform because you make 2.13%, and you called that your margin of safety. Can you explain why that's attractive?
Sure. So with a 0% margin of safety, we expect to earn their cost of capital. Cost of equity, excuse me. Their cost of equity is 15.9%. And so that's why we had an outperform rating in our report. Since then, obviously the stock has done well, and so we couldn't stand here in front of you today and recommend a buy when the prices come up this much. Obviously, if this were a real world situation, we would go in at the last quarter to our models and maybe come up with a new price target if you're doing this for a real firm, but we didn't have that luxury in this presentation.
I'm not sure. I think we have to keep consistent throughout presentation and report. Carl can probably clarify on that later, if you should happen to be chosen to go to Chicago.
Okay.
You had another slide in there that was looking at profitability, and I thought your discussion of it in your report was good, the written report was good, but one of the trends that really stood out to me was that if you look at that SG&A as a percentage of gross profit is come down quite a bit, certainly since 2010, which has been obviously a really good thing for them. What do you think has driven that reduction in that ratio, and do you think it's sustainable going forward?
A little bit, as he touched on earlier, how they keep all their operations in their headquarters and don't have all the different stores run all those operations. That's been able to keep it more efficient, especially as they're continuing to expand, which is why you might expect SG&A to be going up or harder to be maintained lower. So I think that's the biggest reason for why they've been able to keep that SG&A margin down to where their target is at the mid to upper 60% levels. But we did account for that problem, which is why we kept it flat at 70% despite what their goals were, because we do have the same concerns going forward of how well they'll be able to do that.
The price of oil is obviously, the price of fuel is made by a big guess because it's more attractive. But the flip side of that is North Dakota and Texas, so you've got cross currents. Can you make any comments on that?
I'll go ahead. So Lithia does operate in a lot of rural markets, so you're going to have more people buying those four-wheel drives, SUVs, and trucks, and things like that. And so they are benefiting in that aspect from the price of oil because you're selling more of these high-margin, large SUVs. On the flip side of that, if the price of oil goes up, people start looking to buy maybe like hybrids or smaller, more fuel-efficient cars. The profit margin on those vehicles slims down a little bit, and that's something they acknowledge in their 10K as something they'd be concerned about.
Yes. Go ahead.
Are the default rates still higher in North Dakota and Texas for vehicle loans?
So their financing insurance arm of their business, they sell those contracts immediately after they close them to the third party. So essentially, you sell it to a third party, and if the third party has an issue with the debtor making the payments, they're going to Lithia didn't, not that we saw really outline any issues with the third party coming back to them searching for some sort of repayment.
So I mean, this new story to me, and I've known Lithia over the years. Now all of a sudden they've acquired this TCH, which gets them in a whole different market, mega metropolises
Right.
and so on, mega markets. Used to be the nearest dealership was 100 miles away. Sitting in the boardroom when they did this in 2014, what were they thinking? What were they trying to accomplish?
So I think, just kind of the context put this in is, prior to DCH, they had a lot of, I'd say probably majority exposure to these kind of rural areas. So I think honestly the acquisition was very strategic as far as, just getting exposure to a completely different type of market. So I think, we could say that it's just kind of provides some diversification as far as that goes.
Yeah, and additionally, in their 10K, I think it's their 2014 10K, they alluded to the fact that 2 states, I believe it's Oregon and Texas, made up around 57% of their revenues. So in getting exposure to these mega metropolises, they're increasing their sales volume in those areas and kind of, again, diversifying away from that concentration of revenue.
Are there efficiencies of scale as you get bigger?
Yeah.
So one thing that I didn't hear you address today is governance. I'm pretty sure it was in your report. I'm curious, just in full disclosure, I already asked this question to another group, but Lithia was recently sued by a shareholder, and they were sued because the shareholder's upset that they just agreed to basically pay a lifetime annuity of $1 million plus to their outgoing executive chairman, who's also second generation family ownership. Based on your analysis of the governance and what you know, does that surprise you? What do you think of that? Good, bad, indifferent?
Based on my research of the governance, they got a pretty high quick score. And the reason for that is that they didn't have written into their bylaws a lot of things that shareholders and investors would like to see. As far as operation of the board has gone, I don't think paying that guy a $1 million annuity is going to hurt the company in the long run.
You think it's a good use of shareholder money to pay out a lifetime stream of annuity to someone that's retired?
If that's what it takes to attract the best quality board, then yeah.
So I asked this question of the other presenters. The Oregon proposed corporate revenue tax. You factor that into the amount of sales that comes out of Oregon. I believe it's going to be 2.5%. If it happens on companies with 25 million.
We did not factor that in.
But most of our projections were in line with guidance going forward. Even with this new earnings coming out, our projections still matched those ones. So I'm sure that Lithia did project,
Within their guidance.
within their guidance account for that. So we feel that.
Which I think we used guidance for 2015 and 16, so for 2 of the 5 years. One minute.
If you have all these stores across the country and you wanted a ballpark, a target, how many cars you wanted to sell a month, what would it be?
I can speak to the used vehicle segment. They've said they've targeted 75 used cars per month.
Is that new or used?
Used. This is what they're targeting. Like we talked about in our presentation annual report, they're definitely putting a focus on
And that-
used vehicles.
What is it now?
It is 62, I believe.
What's their largest geographic presence right now?
I believe it's Oregon, followed by Texas.
Does that include the effect of TCH?
That was as of 2014, so I would assume, within their 2014 10K, that was not built in.
So valuation aside, what do you think is the biggest risk to?
Time.